Okay, hello everybody. Welcome back to this lecture. So last time we were talking about, well, we discussed first all the different kind of generators that are there, like hydro, nuclear, coal, gas, oil. And then we were thinking a little bit about how do you invest in the best set of power plants. And if demand was always the same, we could probably end up with just one technology. In this setup, probably that would be nuclear. You would only be using nuclear. But now we see, but the problem is that demand goes up during the day and then goes down again. There is variability. This is a little bit still the old paradigm where what we produce is fixed and is certain, but it's demand that is fluctuating. Of course, when we add renewables to it, we add some extra complexity to it. But usually this variability of renewables is then added to the demand. That's actually the way to address this. So if you have renewables, you do not look at the gross demand, but you look at the net demand. Demand minus what is produced by renewables. So this framework is still relevant and important today. Okay, so and you see, I showed you a little bit this game. Unfortunately, I played it only on my computer. Yeah, when I have student live, we usually play it for an hour or so. And you could see that, well, you really had to think a little bit about how much of each of the fuels you need to buy. And one of the things that maybe stuck out was that we shouldn't produce too much. Yeah, if you produce too much, huge negative profits. And you have to make sure that the generators with high capital cost, nuclear, that it runs close to 100%. Basically, the parameters are such that if you run nuclear less than 100%, you're very quickly going to make a loss. But if you run it on 100%, and the price is kind of reasonable during the day, then you make good profits with it. This is pretty realistic. So we see that there's this trade-off. There's a trade-off between, okay, high fixed cost, but okay, it has to run all the time. Or you can take one with low fixed cost, like oil, but yeah, then you just use it sometimes. So you shouldn't buy too much of it. So how do we have to how is this balancing going? So that is what I will talk about in this last lecture. Like basically, how do you do this balancing out? We still see that the game explained. This is actually a very good, if you're making a choice, this is actually a very good choice. Well, you see there's a good profit here. Why? Well, because nuclear is running on 100%. Here we see that here in the capacity factor, runs on 1. Then we have a lot of coal here, but we have here gas in the shoulders. Then we have here oil. And we even have a little bit of shortage, but it's useful because then the price will be very high here. An alternative would be maybe to have less coal, a bit less coal, more gas, and then we could have the gas still spill over in this shoulder here. Okay, here you see the prices. Yeah, so this is pretty good. This is nice profit. Okay, so how do we analyze that? Yeah, let me jump forward. Unfortunately, this didn't work out. So what we do, we are going to make something that is called a load duration curve. And this is a little bit like a cumulative distribution function. It's just slightly different, but we'll see that they will be very closely related. So what is a load duration curve? Well, we have here on the horizontal axis, we have duration. And duration is basically the probability that demand is higher than the level here on the y-axis. Okay, yeah, so let me show you an example because it's a bit difficult to immediately understand, to immediately grasp what that implies. Let's say that we have a daily demand like this. So till 9 o'clock, demand is 1, then it jumps up to 2, in the middle of the day it's free, and then it goes down again. You know, simple enough. Now, how can we put that in a low duration curve? Well, let's see. We need to look at the duration that the demand is equal or higher than, and let us start here. We started at 0. So what percentage of the time during the day is the demand equal or higher than 0? So what percentage of the time is the demand higher than 0? Feel free to jump in or to write on the chat. But I see here that the lowest they get is 1. So demand is always bigger than 0. Always, yeah? So then I draw this in this graph. Okay, 0. This is my point here. I start here at 100. But this is true for any value here. Yeah, up to 1, it's always demand is always bigger, always 100% of the time. Okay, but now something changes. Yeah, once I reach 1, and let's say I jump. Okay, let's say I jump past 1. Yeah, if I'm a little bit above 1, demand is always bigger. Yeah, say 1.1. What percentage of the time demand is higher than 1.1? Yeah, you notice that these parts here yeah, they are lower than 1.1. So it's only this part here between 9 and 17. Yeah, so the question is, what percentage of the time is this between 9 and 17 of the whole day? Okay, 17 minus 9 is 8. So I divide 8 by 24. That's 1/3. Yeah, so that is 33%. So at the moment I go over the 1 here, the graph here jumps here to the left. That's discontinuous because you see we just jump over these horizontal lines here. Well, then it stays the same. Yeah, nothing changes here. And we see only here something is going to change. What is changing? Well, yeah, if we move up, say, to 2.1 here, you see the only time demand is higher than 2.1 is in these hours between 12 and 15. So 3 hours in the day. A day has 24 hours. So 3 divided by 24. Yeah, it's the same as 1/8. 1/8 is 16%. Now you see I have it already here in this graph. So we now jump here and now we go up. Okay, and here again something changes. What changes here? Well, if you go to 3.1, what percentage of the time is demand bigger than 3.1? Never. It's 3 at maximum. Okay, so we have to jump here to 0. And then we can go up what we want. This graph just continues. Yeah, so this is a low duration curve. So in electrical engineering, it's used a lot. And then we also use it, as we will see, to come to the optimal investment in different kinds of power plants. This is very closely related to our cumulative distribution function. Yeah, so let us, for a change, make the cumulative distribution function, because some of you will be more familiar with that. In economics, we use this a lot. In statistics, we use this. So let's see, what would the cumulative distribution function be? We then basically say, that's almost the same, but we ask, oh, what percentage of the time is the demand equal or smaller than what we have? So usually we put then here the percentage on the vertical axis and the amounts here on the horizontal. So let's see, what percentage of the time is demand equal or smaller than 0? Okay, but it's going to be 0. Yeah, it's going to be never. And basically, that's all the same up to 1. Yeah, because if you just below 1, the percentage of time that the demand is equal or smaller than, say, 0.9, it's 0. And only once we reach 1, something changes. Yeah, because what changes at 1? Well, suddenly this whole probability mass comes into action. Yeah, if we go here now to 1.1, then the percentage of time that demand is equal or smaller than 1.1 is exactly these lower horizontal parts. So what is that? Let's see, that's from 0 to 9, 9 hours. And here we have 7 hours, that is 16 hours in total. 16 out of 24 is how much? That is the same as 24.
2/3.
Sorry, I hear something?
2/3, 66.66%.
Yes, very good. Yeah, thank you, thank you. So we jump into 2/3. Yeah, now we continue with this idea. Well, here it stays the same till 2. Yeah, nothing changes. But once we go above 2, then also these shoulders enter into it. So then we have here we have a total of 9 hours, 15 to 24. Here we have 12 hours, so we have 21 hours, 21 over 24. Okay, I wrote here, that must be 84%. 84%. Then nothing changes till 3. And once we are above 3, everything is valid, so we hit the 100. So people more familiar with the cumulative distribution function will come up with this. Yeah? Now let's think about it. What happens if we do? Yeah, a low duration curve is not smaller than, but it's bigger than. But I can actually keep the same graph by changing the sign and inverting these numbers. Yeah, then I have this graph. And now I'm doing like this. Yeah, I shifted a quarter. What do I have now? Now I have the low duration curve. So basically you can always make a cumulative distribution function from a low duration curve in the opposite way, just by some swapping things around. So basically they contain the same information. Okay, I pushed them together a little bit here, but you see that it's basically the same graph. Okay, so this is a low duration curve, and this is a very convenient way to summarize what's going to happen. Now, we made this from 1 day, right? We said basically that this is the typical day. We always have the same day in a year. And if that is the case, then this low duration curve is not only true for the day, but for the whole year. Generally, though, you will have different kind of days. Weekdays are different than weekend days, but you add them all up in a year, and you can calculate it here into percentages, and then you get a low duration curve. And so we do this mostly in all countries when they try to analyze this. Now, we said that demand was totally fixed, but actually in the game that I played, yeah, there were some small random variations in the levels, which is realistic. So how does this curve change if we say, well, you know, it basically has this form, but each of these levels will have a small random variation. How does that change this low duration curve? How would that change it? Let's think about it here. Yeah. So if you have many days, but you have random variations, then we have to start to take averages. Then this line is not going to be so absolute, right? Because if this demand is sometimes, say, lower than 1, then this line should already go to the left earlier. So these lines become less straight. They also become a bit more smooth. So this is sort of a smoothing happening. If we add random variations, we get something like this. And the more random variation you add to it, the more you get a smooth kind of formula. You basically can end up with something like this, and this happens to be a real low duration curve. I think this is from one of the electricity systems in Australia. Okay, now this is a nice low duration curve. Yeah, quite realistic. So we see it's kind of from downward sloping, first very steep, and then kind of almost linearly, and then becoming a little bit more steeper here, and then jumping down here. Okay, let's practice it a little bit. Yeah, so let's try a different kind of load curve and make the load duration curve. This is not totally unrealistic, because we really see these kind of load curves. And that during the day you have low, you come to a peak, and you go down. But this is maybe a nice way to kind of capture the basic characteristic of demand in a typical country. Okay, let us make the load duration curve. Yeah, so let's see. What percentage of the time is demand bigger than, we start here at 0, bigger than 0? Well, all the time. Yeah, we see this is okay up to 1. So just like the previous one, we start at 100, and up to 1, it stays 100. And then, well, let me look. Yeah, once we are at 3 and higher, we are at 0. Yeah, so I will draw this line here. I will draw the line like this. And we have a low duration curve. Yeah? Agreed? Everybody agrees? Oh, no, the slide says there's a mistake. But well, I don't see the mistake. Well, what's the mistake here? I can't go on now, yeah, because the slide says there's a mistake, but I don't know. I think it's okay now. What went wrong here? Oh, fuck. So. Okay, what went wrong here, yeah? This suggests a smooth transition here. But wait a second. We have here a discontinuity, right? Once we pass 1, we should have a huge drop in the duration, because suddenly the time that it's bigger than 1.1 is not 100%. That's only these hours here. That is these 8 hours. So that is only 1/3. So this is wrong. Okay, it should jump here all the way to the left, and then go up like this. Okay, yeah, so tricky, huh? Okay, but the thing is, I really like this curve. Yeah, I don't want this curve here. It's not nice. I want this one here. So what kind of a load curve should I make then? I should actually make it like a sort of like a rooftop. Yeah, so let us check here. If I start here up to 1, nothing happens. Then when we go above this, well, you see that this is a very smooth transition. Yeah, and here my reasoning that I tried before works. Once we are above 3 or higher, yeah, it will be 0. But we see here we have a very continuous decrease, linear decrease. And this is the low duration curve. Yeah, is that clear that using this load curve, yeah, so this for the day, I get a low duration curve for the day with this formula. Is that clear for everybody? No, this is a good moment to ask questions. Okay, let's look a little bit closer at this, your low duration curve. Yeah, we see, okay, here it's basically a linear line, but he ends here at 1. And then we have a vertical part here, but we can just focus on this part here then. So what do I say? I say, oh, okay, now actually the formula is for this part, d is 3 minus 2 times the duration. If the duration is 0, we are at 3. If the duration is 50%, 3 minus 2 times 50%, okay, that is 2. And 100%, 3 minus 2 is 1. So you see, with this formula, I describe this part of the graph. I realized that for some of the, this is not the simplest low duration curve. The simplest one is actually, where I even get rid of this vertical part. So I actually made some exercises with that to make it the simplest possible example. Okay, I have here one question. Compared to the previous graph, please explain the difference again. Yes, of course. Yeah. So let's see. Yeah, so I try to make you think that this is okay, but why is this not okay? Well, let's look here at 1.1. Yeah. Let's look here at 1.1. Slightly up here. Then you see that okay, if this is the line here, let me look at, then we see that actually only here it's bigger. Yeah, the band is bigger than 1.1 only in these hours here, right? But not in these ones here. But if I calculate that, I see that I didn't do it very nicely. Basically in these hours here. This is 1.01. Yeah, it's very close here. So what are these hours? That's between 9 and 17. That's 8 hours here. But just below here, demand is always higher than this level here. So that's 100. That's correct. Okay, this is okay. But once I go to a little bit above 1, it's only these 8 hours. 8 hours or less. Yeah, it becomes less and less. 8 over 24 is 1/3. 1/3, that is about 33%. Yeah, so we see that we need to have here a shock. Jumping to this 33%. Let's see, and then it goes actually very smooth till this gray. This is true. Yeah, because if we are below 3, then we have a very small percentage of hours where the demand is higher than this 2.9. But once we are at 3 or higher, we're at 0. And we have this here as a line. That is exactly what is going on here. Yeah, now I could use this, of course, but I don't like it. It looks kind of complicated. It's not really complicated, yeah, but let's keep things as simple as possible. So I really want this one here. Yeah, I want this one here. And then I thought, okay, so what should the daily demand be like then? It should be like this. Yeah, which is not totally realistic, but not totally unrealistic either. Yeah, why? Well, again, yeah, from 0 to 1. 0 to 1, we're at 100% here. And we see here it's starting to change, but you see it changes only very little here, and it changes with the same speed. Because these slopes are the same, this distance is decreasing with constant speed. So I must have a line that is straight. And where does it end? Well, it should end here at 3. So that's how I know. Okay, yeah. So this is basically, this is a way for us to summarize the demand side. We have summarized demand. We know that it's a little bit random here, and this is a very nice way that we can capture that demand has different levels for different times during the day. You can also even see it as a bit like probabilities. Yeah, what's the probability that demand will be equal to 2 or higher? We say, oh, okay, that's 50%. And we can read that directly from this graph. What is the probability that the demand is equal to 1 or higher, or 100%? Yeah, say 2.9. 2.9 is here, that will be 5%, I think, right? Am I right? I think so, yeah. Okay, so we have here the demand side, but we are working towards supply demand analysis, right? So we need supply. What is the supply side? Well, we actually, as we did earlier, yeah, we looked at that. Okay, we have here two different types of plants, a baseload one and a peaker. The baseload has high fixed cost with low variable cost. And notice that I calculate the cost per megawatt hour. Yeah, so just to remind you, what we did before is we said we built this plant. We say, okay, the plant is going to run for 30, 40 years, 30 years, say. How many hours do we have in a year? How big is this base load? How much megawatt does it have? We multiply the megawatt of base plant with the amount of hours in the 30 years, and we have the total energy. The total energy it could produce. Then we take the fixed cost, we divide it by the total energy it can produce, and we have the fixed cost per megawatt hour. So of course, yeah, this is not a precise number. We don't measure it. We predict it basically. Yeah? You have to amortize your investment, and it's a prediction. It's the best we have. And then we have the variable cost per megawatt hour. This is usually a bit more fixed number, yeah, because we have better idea what this is. We look at the cost of fuel, a bit of the cost of maintenance, and we are much better at that. I say here 0. I mean, of course, it's never 0, but yeah, you can increase it and we'll just complicate the calculations a little bit, but not change the basic message here. And then we have the peaker. We see a very low fixed cost, but then a relatively high variable cost. If you look at that, you would say, oh, you know, base load is much better than peaker, right? Total cost per megawatt hour is 40. Here, the total cost per megawatt hour is 60. But it's not like that. Yeah, why not? Well, for that we use screening curves, and here we put the capacity factor. So what percentage of time in a year is this plant going to be used? And we then put here the cost. And so what about base load? Well, for base load, it doesn't matter. Yeah, if I use it 0% or 100%, I pay basically $40 per potential megawatt hour. Yeah, basically potential energy. Because if you choose not to produce at all, then in this hour you could have produced 10 megawatt hour, you don't produce them, but for the fixed cost you are charged anyway. Well, this is the idea. For the peaker always pays 10, but if the percentage increases, okay, then also the variable costs are going to be added. Yeah, so let's think, if the peaker produces 0, he pays 10. If he produces 100%, he pays 10 plus 50 is 60. Yeah, if you run, say, 50%, then it's 50% of 50 is 25. 10 he pays anyway. 10 plus 25 is 35. Yeah, so in the middle he is at the 35 level. Well, anyway, yeah, it's a percentage only of the variable cost, so it's linear. So we have a straight line. So I just can connect the 10 and the 60 here, and I have here the line. Now, what does this say? This tells me the cost per megawatt hour, and we see that it is the lowest for for the base load here, but it's lowest for the peaker here. And they cross here. So what does that mean? It means as long as I can guarantee that my base load runs 60% or more, then base load is the best. But if the percentage is lower, then I should run the peaker. Yeah, now you see, even if you just added up these numbers here, then you were actually assuming that this plant would run 100% always. Yeah, but this is not possible if you have a load duration curve, yeah, that is anything different than a block figure. And we have different demands during the day, and therefore you cannot run the plant you build, you cannot run it 100% of the time. Okay, so use base load when the capacity factor is bigger than 60%. Use peakers when the capacity factor is smaller than 60%. That's the rule here. Now, how can we put these things together? Now we have, so remember, this is basically a summary of demand. This is a summary of supply. And we did a little bit of analysis on this using screening curves to see what is the cheapest one. Yeah, we summarize it here that, okay, here we use base load and here we use peaker. Now, actual screening curves tells us, yeah, can you guarantee me that the plant is going to be used 60% or more? But this is something that the load duration curve exactly tells me. Yeah, so I look at the 60%. Let's see, what is that? That is 1.8. Because what is the percentage of the time that demand is equal or higher than 1.8? That's exactly the 60%. Yeah, so that means that I can build base load up to here. And I know that the marginal plant, so the marginal base load, so these are all like, say, very small base load plants, all up together, and I stack them up to 1.8. And then the marginal unit, the one that say gets the least, that is the last one to be called to produce, will then exactly run at 60%. Yeah, but the ones that are always called as the first, they will run much more. They will actually, everybody that is in here will be running actually at 100%. And actually the plants that we start adding up here, they are the ones that are running less and less and less. And the last one that we add, yeah, we think that the last one we add will be the last one always to cold, to be called to produce. He will be exactly at this point, and he will run exactly at 60%. And so the 60% is like a marginal number for the time that these plants run. The average is different. Yeah, we don't go into that, but actually you can calculate that quite easily as well. Okay, so we should build this amount of base load. How much should we build it of peaker? Well, basically we build the rest of it of peaker. And so we take these screening curves, we make screening curves, we look where they intersect. This gives us a percentage. The percentage we project on the load duration curve. And the lower part is then the base load here. And the upper part here is the peaker. And this is our optimal investment in plants. Yeah, so you can do these analyses on different systems. I just have here two power plants, yeah, two types, base load and peaker, but you can do it for nuclear, coal, gas, yeah, so you can have a lot of these different plants. Very often you see the real base load is nuclear and coal, especially lignite. Then you have hard coal already going a bit in this direction here, this territory. Gas, some of the peakers will be old inefficient plants, old coal, or there will be open cycle gas turbines, oil plants you can have here. And so we basically talked about a lot of different curves. So just to recapitulate, and this is what we call the load curve, showing the demand over the day. This is then the load duration curve. So we derive the load duration curve from the load curve. This is the demand side. This would be the supply side. We have here something called screening curves to look at what is the lowest cost possibility. And this, we don't actually have a name for it. I call it technology cost table. It basically summarizes the fixed cost and the variable cost. Okay, any questions about this? Let's see. Yeah, so I had this load duration curve, but what I really like is basically to look at where you have demand, and demand can actually say the demand is never lower than 1 and never bigger than 3, but everywhere in between it is with equal probability. Equal probability everywhere in between. So what would the load duration curve look like? Yeah, if we have a typical day and the demand is random, but it's a uniform distribution between 1 and 3. Yeah, so such a load curve should be a little bit like this, at least in the sense that it should never be higher than 3, right, like here, and it should never be lower than 1. What about in between here? Is it going to be a straight line or a steep line, or is it going to be a round? It's going to be a straight line, right? Why? Well, because this is uniformly distributed. Straight line running from 1 to 3. It's exactly this load curve. And it's interesting, right? We have here a different kind of day, basically, but we get the same load duration curve. Yeah, so every sort of load during the day will have a load duration curve, but one load duration curve could actually summarize different kind of load curves over the day. Yeah, why is that? Well, it's because we summarize some information here. Yeah, so we actually lose a little bit of information. It's a summary. It's not perfect. Okay, now why might this be good? Yeah, so let's look. We do the same analysis on it. We get, of course, that also here we need to have 1.8 units of base load, and then the rest of pika. Yeah, so then we can think of it. Okay, we have this in the day. We have these different demands between 1 and 3. And what happens if the demand is smaller than 1.8? What will be the price in that case? If it's okay, I don't say that there. What if the demand is anywhere here? Well, if we have a demand, so say that one day the demand is here, well, the price, of course, is going to be equal to 0. Yeah, because this is basically a supply curve, and this is demand curve. Oh, why is the supply curve at 0 here? Well, that is because the variable cost of base load are 0, the variable cost of peak are 50, and we know that in any of these systems, the price is always set by the marginal cost, yeah, by the variable cost. So we see the base load offers its production at a cost of 0, and the peak at a cost of 50. Yeah, marginal cost pricing, like perfect competition. What if the demand line is at this level? Well, we see it intersects at 50. So here the P is 50. Okay, that means that it looks like this, yeah? So for all the outcomes between 1 and 1.8, the price is 0. For all the demands between 1.8 and 3, it's 50. And I say, well, if you think of it, it's a uniform distribution. So between 1 and 3, yeah, the probability of the demand being between 1 and 3 is 100%, of course. 1.8, 1 to 1.8, that is 0.8 out of 2 units. So that is 40%. Yeah, this is 40% of the area between 1 and 3. So that has a probability of 40%. Between 1.8 and 3, we have an area of 1.2. 1.2 out of 2, that is 60%. Yeah, so this area is 60%, uniform distribution. So what do we expect? 40% of the time you have a price of 0, 60% of the time you have a price of 50. Okay, now we come actually to the last point here. What about these peakers here? Yeah, they're all the way here. The demand is going to be anywhere here. If you see, if the demand is here, this is not a problem for the peaker, right? Because the peaker is not running then. Only the base load will run. The price is 0. But the base load has a variable cost of 0. So yeah, that's completely okay. Now, if the demand is anywhere here, the peaker runs. He gets 50 paid. Yeah, the price is 50. His variable cost is 50. But how is he then going to recover his fixed cost? Yeah, profits are 0. But if their profits, the money they make when they're running, if that's always 0, how are they going to recover their fixed cost? Yeah, this is a bit of puzzle. Yeah, so this is what we call the missing money problem. What I will do, I really need to finish this explanation. Yeah, so I should finish at 10:15. I will probably finish at 10:30. I take the other 15 minutes. Yeah, so how can this problem be solved? I wish. Well, yeah, but it's perfect competition. Yeah, so if you have, remember, the theory says if my variable cost is 50 and I get paid 50, I'm going to produce. Well, we can think that the price is maybe not 50, but it's 50.1. My variable cost is 50. So if I'm in the market, I will produce, right? But we say, oh, but then they make a loss of 10, yeah, because they don't recover their fixed cost. What's the trick here? And notice what I say. If I'm in the market, I will produce. But if you are an entrepreneur, yeah, and say, some of these guys leave the market here, yeah, because some of these plants become old, so they are broken down. Are you, as an entrepreneur, are you entering this market? No, yeah, because at this point I would say, oh, if I enter the market, I make a fixed cost. I get always paid my variable cost, but I will not recover my fixed cost. So I will make a loss. So this is what's going to happen. If the situation was ever like this, yeah, then over time, some of these plants are retired. Then for a long time, business people say, well, yeah, nice, but I'm not investing in the electricity market. But what is happening here? We see that now there is a gap. Yeah? Remember that the demand is between 1 and 3 randomly. So there will be days that the demand is anywhere between 3 and the end of the peakers here. So what do we have here? What happens here? Yeah, if I have a demand one day here, what is the situation? The supply coming here, we have demand here. And maybe you notice more like a situation like this. Let me see. You have supply like We have supply and then we have demand here. Yeah. Yeah, they do not intersect. So what happens then? We get a very high price. Yeah, price is going to be insanely high. We have this infinite price thing. Price is going to be very high. But we said, okay, the regulator will not allow an infinite price. Yeah, we don't know anyway what it is. So there's a cap. They have this very high price. Okay, but think of it. This is the time. Yeah, if the demand is anyway here, the price is very high. This is the moment that all these guys earn a price higher than the variable cost. This is the time they make a profit. So how does this process work? In the end of the day, the gap here needs to be exactly big enough for these guys to recover their fixed cost. Yeah, so it depends a bit how high is this price. Given a level of this price, we can actually calculate what should be the percentage of time that there is a shortage, because then everybody gets the money, and it should be exactly such that these guys recover their fixed cost. And that is a surprising conclusion, that for the system to work, we actually need some shortage. Some of the time you need what we call scarcity, that there are some people who want to buy, but they are unable to buy. They need to be disconnected basically by the operator. And so the shortage, the price, well, what should this price be? We usually talk about something called value of lost load. So this is the opportunity cost of electricity that is not delivered, say, to a household. And this is generally very high. Right? That we think of 10,000 euro or dollar per megawatt hour. And so what should this cap be? Well, so let us look here at this one example. We have here a cap of 10,050. Yeah, we see the rest of it is all the same as what we just talked about. What do we need? Well, the profit of the peaker is in this. So if the demand is anywhere between 1 to 1.8, 40% of the time, profit of the peaker is 0. What about here? Profit of the peaker is 0 as well. But here, in this time, the expected profit of the peaker should be equal to 10. Yeah? Should be equal to 10, because only then, yeah, people, when a plant here now leaves, a businessman will enter to fill up the gap. So we need that the percentage of time that this happens times, well, let's see, 1,050. If you get 1,050, you still have a variable cost of 50. 1,050 minus 50 is 10,000 is then your profit. And then times a certain percentage such that this is 10. And so I calculate that as 0.1%. So now I know, this gap here should happen with 0.1%. Yeah, so we actually have them. We can calculate that the amount of peakers we have goes to 2.95. This is 2.95. Which is about 9 hours in a year. Now you sometimes have generators, you have regulators saying this is very high, so they put much lower, because they don't want to have these very high price spikes. They want to have a price of just 550, say. But we see that, yeah, this gap is not going to work. They will earn only 0.5, which is much lower than the 10. So what happens then over time? Yeah, here plants are going to be taken out of production, and no businessman will say, oh, we're going to invest. So it becomes, the gap becomes bigger and bigger and bigger until the gap is big enough to exactly cover the fixed cost. So how big should this gap then be? Well, we need it to be 10, so we calculate, oh, that's 2%. Yeah. And you see, oh, well, regulators happy. Yeah, the price spikes are capped. They're never higher than 550. But the time that there will be a shortage is now suddenly much bigger. That's 2%, which is actually quite large. 2%, that is 10,000 hours. Yeah, that is, that's 200 hours in a year. That's a lot. So 200 hours in a year, there will be some people that are disconnected. I see. If initial caps are high, will not consumer deter to buy? Well, the thing is, buyers generally get. No, it will not. Yeah, because, well, first of all, most consumers actually get an average price. Yeah, you get the average price, and I won't do that here, but if you calculated the average price is actually 50, that's very reasonable. Because think of it, a lot of the time the price is exactly 50, 58%. 40% of the time the price is actually 0. Yeah, but you don't see that because you pay the average price. And then sometimes it will be 550. Yeah, so this consumers will just buy the electricity like normal. However, it would actually be good if consumers saw the price. Yeah, if they are not given an average price, but the real price in the market, then we see this time they would get a price of 0. No? So they would then, oh, we're going to pump up the batteries now. Here they would see a price of 50. And in these times, they would see a price of 550, which in a sense is good because then they're like, oh, now the price is very high. I turn off some of the light. I turn off, say, some space heater right now. I don't load my battery, but I'm going to charge for my battery. Yeah, that would actually be a more economic outcome. Yeah, so let's see. The general case, well, let me explain it now with one example. So I jump over these here. Here I have. Okay, so here I have 3 different kind of generations. I have base load, mid load, and peaker. And so I do the same thing as I did before. I have the base load, it's always 60, mid load 35 to 55, right? And then I have a peaker from 20 to 70. This is, and then in a sense you can say turning off people, yeah, the shortage that we saw is also, we can take it as a sort of generation in a screening curve. So we have so cutting off the electricity for people, curtailment, has 0 fixed cost, but it has as a cost the cap in the market. So this is actually the cost of curtailment. And we can take it basically as a generation, and now we can use this screening curve way to solve the whole problem. Now, there's one step we can do to make this problem a little bit more easy. And what is that? Well, we see that the base load is more expensive than any of the other ones. Yeah, it's actually more expensive than mid load. We're not going to use base load again. Yeah, so we take base load out. This is our problem now. Okay, now we just need to calculate these intersections. So we have these intersections, and if you look at that, so I write here the formula for mid load. It's 35 plus 20 times the percentage that I use it. That is the duration of mid load, going from mid load to peaker. This point here, and here I write a formula for the peaker. 20 is its fixed cost, 70 the variable cost, times the duration of the mid load for peaker. And now I solve this for the duration, and then I get this point here. So okay, that's 0.3. This is 0.3 here. Okay, now I'm interested in this point here. Yeah, I need to know actually what will be the duration of shortage. So I look at the marginal cost, or the cost here of Pika, which is 20 plus 70 times the duration. Then I write the duration PS, because we're between the Pika and shortage. For this intersection, 20 plus 70 times the duration should be equal to, you see, shortage, fixed cost is 0, yeah, but the variable cost is the cap, yeah, because you can think cap is the highest price in the system. So this is like the opportunity cost of electricity. If you say somebody, you cannot use electricity, and basically, yeah, the cost of that is the highest price you can have in the system. That is 270 times the duration here, and I calculate it and I get a duration of 0.1. And so now I've calculated the durations here for what is the cheapest. So the duration is above 0.3, mid-load. Between 0.1 and 0.3, I provide the electricity with the Pika. If the duration is less than 0.1, I just don't provide some of the electricity. Some people are going to be cut off. So I put that here in this graph, in the low duration curve, and I come to these optimal investments. 4.7 here and 0.2 here. Okay, yeah, so this is an analysis. This is used broadly. It's used for for planning, of course. It's used in all kinds of analysis. It's used in a lot of the reports that you have for, okay, we want to have more renewables. How is this going to affect our system? The renewables are added basically to the low duration curve. And then we can see, oh, we need more flexible generation. We need a much more, say, oil generators, usually much more gas-fired generators like open cycle gas turbine. Well, a lot of the base loads we're actually going to need less of. Yeah? I don't go into details here, but there are a lot of studies there, and basically they all use this as a principle. And this is a great model to use. And if you understand this model, you understand more than most politicians, most journalists, and probably half of the people working for the energy regulator, because they're lawyers. Yeah, you understand more of it. Okay, so we're coming to the end of the lecture. I even almost used up the 15 extra minutes that I stole from your local instructor. My apologies once again. I had actually wanted to have a little bit more time to talk about this, so my apologies for that. I'll try to do that better the next time. I understand that this is somewhat complicated, so I will look at the homework was a question in it, and I will look at it benevolently, and I will do the same with the exam. There will be some question on this, but it will be more of a simple kind. Anyway, the local instructors still have 2-3 of these problems that they will present to you. And with that, we come to the end. Are there still any questions at this point of time?
When will the exam start?
The exam starts at 10. Yeah. So there was, it should have been 9:30, but there was some scheduling problem. I think some people had more exams on that day, so we changed that to 10 o'clock. Yeah, it's on the Moodle. It's changed on the Moodle.
So can you please share your contact or email ID? Because if we will have any problem from all the all the course that you have covered so far, then we can write it to you.
Okay, what was the question? Because I didn't hear it well. Can you repeat it, please?
Sir, I'm saying, can you share your contact? Can you share your contact or email ID? Since we'll go through the entire course now, and if we will have any problem, then we will write it to you.
Yeah, sure. I think my email is actually on the Moodle, huh? But I also will be online,
okay.
And I will put my I probably on a Zoom or on a Google Meet, and I will put it on the Moodle. Yeah?
Okay, thank you, sir.
Other questions? Okay, I hope the exam will be like the homeworks. Yeah, will be very much like the homeworks, and it will be on Moodle. Which date the exam? It's Wednesday now. This is on the Moodle. Huh? I can say now, I don't see the Moodle now. I can say something, I could be wrong. Look on the Moodle, there's the date of the exam.
So one more question.
Go ahead.
So if you want us to pursue anything after taking this course, so what will you suggest in energy economics?
Okay,
What can okay.
I will upload the document on Moodle that gives you some pointers. And you're also free to write me. Yeah? You can write me and ask me. I can send you some stuff.
Okay, sir.
Yeah. No more questions? Okay, hey guys, I love talking about energy economics, so it was great to talk to you. I also really appreciated the questions. You have very good questions. It's always a joy to see some the questions people have, because they have a perspective that I sometimes don't think about. And for me, it was really a joy to have these questions. So yeah, take care. Enjoy the last session. Good luck on your exam, and hope to meet you at some of a student or in your professional life. Bye, guys. Take care.
Thank you. Thank you so much, sir. Thank you.